I'll tell you what, guys, the most surprising thing to me right now is the fact that things have been so good, right? We had 2 big years in the stock market. Seems like the economy is like chugging along on all 6, 7, 8 cylinders. I don't even know. I'm not a car guy. But if you look at sentiment right now, it's extremely bearish. It's really interesting. But most investors right now, for some reason, have become very, very skittish, which I find very, very interesting.
Wait a minute. Hey, Chris, is Ryan not a car guy because he crashed every car he ever had?
Just as long as it's not stick shift.
Only twice, and it was a 6-shift truck that I should never have owned. But that's another story altogether.
Well, you know what? You forgot one thing that's going really well. The Eagles just did win the Super Bowl, and you forgot to mention that. But yeah, I mean, I think I would say my clients are kind of on both ends of the extremes. Some of them are, super bullish. They don't want to sell out of any of their risky assets, whereas other clients are calling me up and saying, "Hey, Chris, don't you think the market's getting a little bit choppy?" As a matter of fact, Courtney, I think you had a client that you were telling me about that just absolutely refuses to get out of their Bitcoin. They're up like 200%.
Oh, I think even more than 200%. They're doing fantastic, which is awesome. But yeah, this is, I think, a good example where I'm seeing the same thing you are. Like half of my clients are really risky and half aren't. So this is actually a couple I spoke with. And the husband is the one who wanted to get Bitcoin against our better judgment, but has done really well in it. And I was saying, we're looking to take profits. Markets are doing well. We're rebalancing everyone's accounts. Let's take some profits from Bitcoin. You did not want to take profits from Bitcoin, nor any equities for that matter, where I had the wife who was saying, yeah, I completely agree. Let's take profits. Things are doing well. We don't know what's coming next. And in the same conversation, you had one person really risk on, one person willing to take risk off. And that's what I'm seeing across the board. It's very split right now.
And statistically, this is why women make better investments than men
That's
do.
true.
Because of fooling their money, they're lucky to get together in the first place. Right, Bob?
That's true. And it's, and when you talk about risk, guys, risk is something that's only completely understood in hindsight. And that's what makes our job so difficult, why it makes investing so difficult. And it's why we stress those wealth projections, because all we think about is what can go wrong.
Well, no, it's a great point. And I think the problem right now is on Capitol Hill, every day, there's something new going on. Doge is going to do this. Well, or maybe Elon Musk needs to get sued because he's taking too much power. And it's like this big arm wrestling, match that's going on Capitol Hill. We don't know when. Some days it's tariffs on, some days it's tariffs off. But I think it gets away from the big picture, right? The economy is growing at a much faster rate than the last decade. If you look at earnings growth, it's coming in phenomenal for last quarter, right? Totally blowing out expectations. And next year, earnings growth is going to continue to do really, really well. And we know that's what drives the stock market long term. So if you look at just the fundamentals and you take all the BS out of it, like this is as good as it gets to be an investor right now.
And that's what you need to do, right? You need to look at what are you actually investing in. We're investing in these companies, not in the governments or the governmental policies, which I think we get a little lost on what they're covering on the media right now. But yeah, things look really good. I mean, companies are reporting very strong earnings numbers. You're continuing to see the consumer is holding in there. Like it's really good data coming out in the economy. And that's what you want to be investing in, not on the headlines that are going to be different every day.
Well, the market's concerned about these tariffs, and they're looking back in history saying, well, is he President McKinley or is he President Hoover? And where the market wants him to be Teddy Roosevelt, right? Speak softly and carry a big stick, as opposed to what Trump's doing. He's speaking loudly, often threatening tariffs. But so far, looks like the results have been pretty good.
As a matter of fact, that, when these things happen, people always say, oh, well, this is guaranteed that it's going to happen. We're going to have tariffs. The market's going to go down. But, the reality is things like emerging markets have done well. Our foreign stocks have done well.
Well, yeah, right. It's let's face it, tariffs are horrible for Europe. But wait a second, Europe's almost 8-9% for the year. I don't get it. Germany's at an all-time record high, their stock market, right? So you don't know how these things are going to pan out in the stock market. And also, I think the other big theme we talk about every week, which trumps what Trump's talking about every day on Capitol Hill, is the productivity gains from artificial intelligence, right? It's real, it's here. We're using it in our business. Every business is using it. That's going to make their companies more efficient. That means their bottom lines go up, profits go up. These are all the things you want as a stock market investor. And it gives you the opportunity to invest in everything because every company benefits from AI.
I haven't noticed any productivity gains coming from Ryan, but
I can be even lazier and create the illusion I'm working harder, Chris. It's the greatest thing that's ever happened to me.
Chris, I think he has an AI alarm clock now. He's actually been on time.
Now, AI has been fantastic. I'm just trying to find how I can use it in my day-to-day life or my job. And, every day I'm finding very applicable uses for this. And even just this week, I was looking at a client's account We're analyzing a 401k. This usually takes me anywhere from 20 to 30 minutes, do my full analysis, look at all my research. I was able to put this into AI and I got this done in 5 minutes. I still can't fully trust it. I did find some mistakes in it, which is why you have to have somebody who watches it. But just the amount of time that it has saved me is amazing. And I think we're only hitting like the cusp of that right now.
You know what's interesting? I heard about AI like 2 years ago and I'm using it every day in my business. I've heard about Bitcoin now for almost a decade. And I'm still not using it to buy anything. So go figure. I digress.
Yeah, I remember that video you did. I guess it was maybe 4 years ago. You tried to buy a Starbucks coffee with Bitcoin, and they actually ended up having to throw you out.
Actually, the lady felt so bad for me, she gave me a free coffee.
The thing that the danger about AI is it's just putting all the information out there to get, at your fingertips to make it easier to access. But if the information's incorrect, for example, 100% of the economists predicted a recession that never happened. So, you can't use it for advice, but you can certainly use it to leverage your time.
Well, I think it comes down to is entrepreneurial capitalism always wins, right? Let's face it, whatever bad decisions they make on Capitol Hill, whatever bureaucratic institutions want to slow down the economy, even with the Fed, literally raising interest rates, how many times over the course of the last 2 years we had supply chain issues, hyperinflation, all these things, and companies are just becoming more efficient and better at what they do. So it's so hard to bet against that. And that's why it makes so much sense to be an investor long-term and not wait on the sidelines for everything to get figured out. It will get figured out.
Well, I think some of the negative pundits keep telling us, well, the economy has been going up for a couple of years. The market's been going up for 2 years. It's already long in the tooth. Well, hey guys, I was here for the show in the 90s, and the 90s went almost 105 months. Not even halfway there. So, if people need some example in the past of why it can continue to be good, you only have to look back at the 90s. And, let's party like it's 1990.
Yeah, and I always go back to the visual of Dad. I remember your way of efficiency was you had a rule that all the letters that came in the day, once you touched it, you had to deal with that letter. You had to either do a correspondence back, put it in the shredder or whatever. It had to be done. And just think about how much, and that was super efficient, how much slower is that than email, right? Just simple things like that.
Now, the level of efficiency is amazing. Well, just look back at the stock exchange back in the 60s, early 70s. They had to shut it down because the back office couldn't keep up with the paperwork. Think about that. We're only doing a couple of million shares a day versus now. They had to shut the market down because it was inefficient, the back office.
Yeah, look, the bottom line is, the technological revolution is here. It's going to impact all of us in the most positive way ever. Just regardless of what's happening in politics, regardless of what's going to happen with tariffs, what's going to happen with deregulation, what's going to happen with the deficit, we probably have one of the greatest times ever to get diversified, buy for the long term, create wealth for you and your family. Don't miss the boat. Uncertainty is your friend.
What I hear from all of you guys, you're just talking about the efficiencies and, what artificial intelligence, what technology is doing, right? So you see all these companies, 50% of capital spending right now is on high tech. And the fact of the matter is technology is leading to high productivity, which leads to growth, which leads to earnings, going higher, right? And that's the E in the PE. So the E goes up, the P's going higher. Don't miss out, right? Don't wait, for the market you want. Invest in the market you have.
Hey, hope you're enjoying the most recent episode of Pain Points of Wealth. Everything you hear on this podcast, along with some due diligence of your own, can help you get ahead financially, literally at any stage of your journey. But if you want a more hands-on approach and you saved over $1 million, Bob, Chris, and I will put together for you our total financial master plan, and we'll do that with no obligation or cost. It's a full holistic review. We literally look at everything. We go as far as building you your own personalized financial portal. We'll give you a bird's eye view of your entire financial life, and we'll hone in on every financial issue you need to address today. Whether it's an income plan for retirement, how do you take Social Security? How do you draw from your portfolio? How do you factor in inflation? We'll build a dynamic income plan for you. We'll look at diversification. Has your portfolio been up and down with the markets, extremely volatile, or have you been sitting in cash? Paralysis by analysis. You can't figure out what to do. We'll put together a full investment game plan, tie it to your goals, show you how to grow your wealth, but most importantly, protect it over the rest of your life. And we'll look at fees and taxes. Wall Street loves to sell you high cost, tax inefficient products. Whether it's an annuity, mutual fund, brokerage product, we'll do a deep dive of every investment you own. We'll show you how to reduce the cost, optimize your portfolio for taxes. It's not what you make, it's what you take. You'll get our full tax playbook. If you want this full holistic review and you saved over $1 million, simply go to www.paynecm.com/financial plan or click the link below to see if you qualify for a free financial review. All right, so tipping point. This is where we pinpoint the pain point. Of course, that's Payne, having the biggest impact on your wealth right now. And you know what, guys? One thing that got my bacon, as they say, last week was we had a real surprise. I don't think that ever works, by the way. Is inflation numbers came in much hotter than expected. And, it made me think of when it comes to building your portfolio, typically what moves the markets or what moves the needle or whatever's not anticipated. More than ever right now, there's so much uncertainty, specifically what's happening right now with tariffs. Are we going to pay down the deficit? Are we going to get tax breaks? And I don't think anyone really knows what's going to happen. And the question is, how do you build your portfolio in the face of all that uncertainty?
Well, a client of mine called me last week or 2 weeks ago and said, with these new tariffs, the market's guaranteed going to go down. Like the market's completely going to suffer from these tariffs.
As opposed to the pro-Trump investors who say, well, Trump uses the stock market as his scorecard. So it's got a Trump put, right? Every time it goes down, he's going to do something to make the market go back up. Like he has a magic wand. That's
I think what's interesting that happens right now is the media loves to focus on these political headlines, and they do that specifically in a Trump presidency. This happened, 4 years ago. This was all over the headlines, and it's all people can think about. But it's not the only story, right? You're talking about tariffs and tax cuts, and that's what's coming from Capitol Hill. But AI is the other big story. And the question is is that going to play out the way that people expect? Is that already priced in? I don't know. And that's why you want to make sure you own a little bit of everything in there. Because we talked about this earlier. Europe is actually one of our best performers this year. Banks are doing really well. It's not really your AI trade that's, again, is all the news talks about. There's a lot of other stories out there that aren't covered as much.
And we can tell you, because we see all your portfolios, nobody has Europe in their portfolio. Or, commodities, right? Commodities up 7-8% this year, which is an inflation hedge. And I think that's the mindset right now is hope for the best, but prepare your portfolio for the worst or any scenario, whether it's a weaker dollar, stronger inflation, right? If the deficit continues to spiral out of control. And I would say most people's portfolios aren't prepared for those scenarios. And that's exactly what you should be doing right now.
I think the scariest thing that I ever hear is when a client or a friend says to me, Chris, I'm feeling really comfortable with the amount of risk I'm taking right now, especially when they're taking too much risk. It's like that comfort is great until the car hits the wall.
Well, you guys, I've always stated this and believe it firmly that you make all your money in bear markets. But it's also, it's the old adage of, buy low, don't buy high. And a good example is, because of all this tariff talk, you saw Constellation Brands just go over a waterfall last week, right? Just right down an elevator shaft. And all the analysts fell over each other, selling, dumping their opinion until Warren Buffett went in and bought it at its lows. So, it's like this, if you're a good investor, right, you recognize opportunity when things are out of favor, not when they're in favor. And that's what scares about the retail client, being so comfortable with that extra risk, Chris.
Well, it's a good point because uncertainty is high. That's usually your best time to invest, right? When uncertainty is low and everyone's feeling good, you're paying too high a price. And I think the nice thing about right now is, well, look, if the dollar's weakened, you want to own foreign assets, right? They're going up. If inflation goes higher, you want to own commodities in your portfolio. You want to own materials. And the nice thing is right now, all this stuff pays a lot of cash flow. So you get paid really, really well to prepare yourself for any scenario. And I think that's what most investors are missing right now. Again, blindly buying the S&P 500, you own a bunch of tech stocks and you're getting a 1.6% yield. That's not going to defend against all these different scenarios.
I think I'm getting a little bit of a new slogan here for Payne Capital Management. It sounds like you really should be investing in something when it doesn't feel good, like when it's painful. So maybe we should say invest painfully, Payne. You heard it here first.
Yeah, I think the bottom line right now is when you're starting to look at all the different scenarios out there is we got to remember things are going to change. And when we look back retrospectively, whatever did well the last 10 years typically aren't the winners of the next 10 years. And I think that's the problem the way we invest, right? It's either this all or none scenario of either I'm 100% sitting in cash, waiting in a money market fund, or I'm going all in on, let's say, the S&P 500. And really, like more than ever, that's probably the wrong strategy given the fact that there's so many different variables at play right now.
I think that's the hardest thing to do, is to block out the noise and not listen to what your friends are saying. Oh, I've got all my money in Nvidia, or you're hearing the news talking about what the best thing is. You really do need to be focused on your own goals and how much risk do you need to take and how diversified should you be, because it is so different for everyone. And I think that's something that we see as planners is, what somebody spends or what somebody has in their net worth is just completely unpertainable to the next person. And so that's where I think it's really important to not listen to whatever the hot topic is right now, because it might not pertain to you.
Well, I'll tell you the biggest risk out there right now is people thinking that the bond market, bear market is over, like bonds can't go down. And that's why you need to own individual bonds, high quality bonds that have a coupon, a fixed rate of return, and a maturity date. Because if you're in bond funds, you're in a position where you can lose equity, have equity-like losses, right? While you're thinking that you're safe. So I think that's one of the things that I don't think the market really recognizes right now.
Well, I think ironically right now, the worst place to be is ultra safe or ultra risky. And what I mean by that is, right, if you have money in a money market fund and CDs, well, the Fed could continue to cut interest rates, right? That money market fund used to pay 5. You sent out the report today, Bob, we're down to 4. What if that goes under 4%? That doesn't help with your retirement. Getting under 4% on something you pay taxes on and inflation eats away at your return, bad place to be. But on the flip side, this awesome risk on trade we're seeing right now, whether it's crypto assets, right? It's levering up AI stocks like Palantir, which trades at 200 times forward earnings. Great in the short term, but man, oh man, potential for that to end very, very badly is extremely high. To your point, Court, like we have no idea if all that spending that's been going on in the AI space is going to continue. And it's only projected right now, by the way. That could fall off a cliff at any moment, especially with all these disruptors out there now, like from China.
Well, guys, always remember past performance is 100% indicative of past performance. You can't get last year's return on an investment by buying it now. You have to buy something it's about to go up, not something that's already up to an extreme level of valuation, hoping on the greater fool theory that somebody will be dumb enough to buy it after you do.
Well, there always is.
Come on, Bob. We've learned that crypto businesses which create more crypto is better than owning Berkshire Hathaway, which has real productive assets. So it is getting crazy right now. You're seeing a lot of people that are quote unquote becoming experts because we're in this hot bull market. But I would say be very, very wary of gurus right now. And you have to start thinking, what we do as wealth advisors, right, is we always think about what's the worst case scenario. What happens if we get much higher inflation than anticipated? What happens if we don't pay down that deficit and the dollar starts to tank? Do you have a portfolio that can somehow be insulated against that? And again, every portfolio you look at, I can promise you your Bitcoin assets or your Nvidia are not going to protect against that. All right, Bob, as of the latest data, only 41% of the S&P 500 company earnings are generated overseas. Meanwhile, the dollar is down over 1.6% for the year, while a basket of European stocks are up over 10%, which says to me the S&P 500 is not really a good hedge if you want to own a global portfolio.
It's always been the argument over 50 years, right? It's like, well, I don't want to buy non-U.S. equities because all the companies in the S&P 500 do business in different countries around the world. But the fact of the matter is, a stock trades in line with its index. So when you had a period of 10 years where the S&P was down and Europe and the emerging markets were up, it was a 7 to 8% return a year versus 0. So, that whole argument, it's like an urban legend. I buy companies that do business in Europe, so I don't have to own any European securities.
And I think that's much less than it used to be, actually. I think it was a higher number if you go back a couple of years. But you heard it here first. Diversify globally, Bob says. All right, Chris, the audience for the Super Bowl reached 126 million people, a record. The Eagles walloped the Chiefs. If you weren't watching, it was a good day to be a Philly fan, as we are.
I mean, the Eagles devastated the Chiefs. I actually had a chance to go down to the Eagles parade last Friday. There were 1 million people there. And, most people go to the circus for the sideshow. You just had to go to the Philadelphia Eagles parade. There was literally a guy riding his horse around. It wasn't a cop. It was some dude who had his own horse. He brought his horse to the Eagles parade, just to give you an idea of what that was like. Absolutely crazy.
You still look hungover, dude.
Always look better than you, though.
It's a bro on a pony.
It's a bro on a pony. Tony on a pony. Yeah.
With a real Philadelphia accent.
That's right.
Incredible.
Hoagies and horses.
Hoagies and horses. If you're not from Philadelphia, you won't understand.
Yeah.
All right, Courtney, how times have changed. In 1978, President Gerald Ford told the National Restaurant Association that the 3-martini lunch is the epitome of American efficiency. Where else can you get an earful, a bellyful, and a snootful at the same time? For the record, a snootful means alcohol drink to make one drunk. I didn't know that. Well, unfortunately, a sign of the times, last year, a record 45% said that 1 or 2 drinks a day is unhealthy. I know that Chris gets disappointed when he hears that stat. That's up 6 percentage points in a year and 17 points since 2018. This young generation just doesn't like to drink.
It is like a good liquid lunch.
Yeah, I'd be curious to know like what age group that percentage is coming from, because that's what you always hear is it's the younger generation who is like moving away from alcohol. And Bob tells me this all the time. He's saying that we're driving up your wine prices, right? Because we're not buying it enough.
Well, what's happening now is you're seeing places like Napa Valley. They're really struggling because the younger generation is not drinking wine. They're doing these. I mean, I used to go to Napa Valley to go wine tasting for free. Now it's like $250, $400 to just taste their wine. People are saying, the heck with that. They're not even going. So I think you're seeing a lot of, a lot of people not drinking at all. And there's a lot of alternatives now, not just
the cannabis industry, Bob. That's where everyone's going who's younger. Yeah.
Everyone's smoking weed. In fact, anecdotal evidence, I went down to Naples, and I can tell you the baby boomers enjoy drinking. You heard it here first.
Well, I talked to a buddy of mine the other day who has a phenomenal wine collection, and he says, I don't think if I cut back my 1 glass of wine or 1 bottle of wine every other night is going to save me any time of my life now that I'm in my 70s. So I think it's kind of a fatalistic attitude, like, I'm not. I'll take my chances at this point.
A little dark, but a little true. Hey, hope you enjoyed episode 193 of the Pain Points of Wealth. If you like our podcast, you love our podcast, please don't be shy. Let people know about our podcast. We'd appreciate the support. If this is on iTunes right now, you can give us a 5-star rating. If this is on Spotify, you can also give us a 5-star rating. Subscribe to our channel. If you're watching this on YouTube, you can like this episode. You can subscribe to our channel as well. Click that notification bell. We update it every week of all our new content. Your support, getting the word out, gives us the support to continue to do this podcast. That's it for this week. As always, stay loose and keep an open mind.
Thanks for listening to the Pain Points of Wealth. Hopefully you found the ideas discussed in this episode valuable and useful for your own financial journey. You can find out more about Bob, Ryan, and Chris's firm, Payne Capital Management, at BeBullish.com or through the contact information found in the description of this episode in your podcast player or app. Join us next week for another episode of The Pain Points of Wealth, brought to you by Payne Capital Management. Information provided on today's show is provided for informational purposes only and does not constitute investment, tax, or legal advice. Investment is obtained from sources that are deemed to be reliable, but their accuracy and completeness cannot be guaranteed.